Listen to me. If you are retired or getting ready to hand in those keys and retire, I need you to stop what you are doing, sit down, and pay very close attention to what I am about to tell you. Because so many of you are walking straight into a financial tax trap, and you do not even realize it. You have worked 30, 40, maybe 50 years paying into Social Security. You paid your taxes on every single paycheck, and you thought, when I retire, this is my money. I've already paid taxes on it. But then tax season rolls around, and boom! You get slapped with a federal tax bill on your Social Security benefits. How is that possible? Why is the government taking another bite out of the money you earned? It happens because of a sneaky, cold-hearted mathematical equation called the combined income formula, sometimes known as provisional income. And if you don't understand how this formula works, it can cost you thousands upon thousands of dollars in retirement. So what is this combined income formula? Let's break it down right now, plain and simple. The IRS takes three numbers and adds them together. First, your adjusted gross income, that's your pension, your traditional IRA withdrawals, your 401k distributions, capital gains, dividend payments, and any job income. Second, your non-taxable interest, yes, that includes municipal bond interest that you thought was totally tax-free. The IRS pulls that back in for this specific test. And third, exactly 50% of your total annual Social Security benefit. You add those three things together, and that is your combined income. Now here is where the real problem lies, the tax thresholds. If you are single and your combined income is between $25,000 and $34,000, up to 50% of your Social Security benefits become taxable. If your combined income as a single person is over $34,000, up to 85% of your Social Security benefits become taxable. If you are married and filing jointly, if your combined income is between $32,000 and $44,000, up to 50% of your benefits are taxable. And if your combined income as a married couple is over $44,000, up to 85% of your Social Security benefits can be taxed. Can you believe these numbers? Do you know when these thresholds were set? 1983. Over 40 years ago. They have never been adjusted for inflation. Back in 1983, only about 10% of retirees had to pay taxes on their benefits. Today, because of inflation and cost of living adjustments, over half of all retirees are getting taxed on their Social Security. The government lets your benefit rise with inflation, but they freeze the tax threshold, pulling millions of middle-class retirees into the tax net every single year. It is an absolute silent tax hike. And the fear is real, my friends. I hear from people every day who are terrified to take an extra $5,000 out of their traditional IRA to fix a roof or take a family trip, because pulling that extra money pushes their combined income over the threshold, triggering a tax domino effect. Suddenly, taking out $5,000 costs you way more because it makes your Social Security taxable at the same time. That is what we call the tax torpedo, and it destroys retirement cash flow if you aren't prepared. So, what are the actionable takeaways? What can you do right now to protect your hard-earned money? First, look at your income sources. Roth IRA withdrawals and Roth 401k distributions do not count toward adjusted gross income, which means they do not count toward your combined income. Money in a Roth account grows tax-free and comes out tax-free. If you do strategic Roth conversions in the years before you start claiming Social Security, you can dramatically lower your taxable income in retirement and keep your combined income below those thresholds. Second, watch out for required minimum distributions, RMDs. Once you hit RMD age, the government forces you to take money out of pre-tax accounts whether you need it or not. Those mandatory distributions spike your AGI, which spikes your combined income, forcing up to 85% of your Social Security to be taxed. If you are over 70 and a half, look into qualified charitable distributions, QCDs. You can send up to $100,000 directly from your IRA to a charity, satisfying your RMD without that money counting as income on your tax return. Third, plan your claiming strategy wisely. Don't just claim Social Security on autopilot at age 62 without calculating how other retirement withdrawals will interact with your benefits. Knowledge is power, but action is wealth. Do not let the combined income formula surprise you. Sit down with a qualified tax professional or financial planner today, evaluate your income streams, and take control of your financial destiny. You worked too hard for this money, now protect it.